Welcome to the WangHiro podcast, where we answer Malaysians' burning questions about personal finance with fact-based answers. Inari is Malaysia's largest semiconductor player. Its earnings have been dampened, however, by weakened Chinese demands for its products, as well as a slowdown in demand for smartphones globally, among other factors, of course. Nonetheless, Inari share prices saw double-digit price surges between May and June this year. Plus, its Yiwu factory, a 55% owned joint venture with YSIC in China, has been completed. Welcome back to Stock Investing from Zero with WangHiro, where we put a beginner's lens on stocks and help you decide if you should invest in it. So, John, what should an absolute beginner look at when considering Inari for investment?
Great introduction, Louis, especially about their venture in China, the JV. More importantly, we go back to the four foundational questions. What business are they in, and what do they do, and how do they make money? Are they profitable financially or financially stable doing what they do? Who is their audience? How big can they grow? And are they cheap or expensive? So most importantly, where are they in a value chain in the semiconductor industry? Now, I'm not gonna go very, very deep into it because it was easily going to take an hour just to explain the value chain. But think of them as almost at the end where they provide packaging for the integrated circuit that you see. So you think of a semiconductor wafer, a guy like TSMC will make them, and then Inari will actually take this whole wafer. You think of the wafer like a biscuit, right? And they're going to cut and slice and dice it, and then they're going to cover it with plastic, and they actually put legs on them.
Oh,
that's what they do. So it's like, you think of, if I were to think of like a biscuit, right? So someone will make the top, and then they make the filling, and then they make that one, right? Then you need to wrap the biscuit, right? So think of them like a biscuit wrapper. I'm using a very simplified analogy, but I think that's how I best describe them. And the chip actually needs to talk with the other components within the motherboard, right? So you need legs. So actually that's what you call a lead frame, a LED. So think of the big biscuit will come from a guy like TSMC or a wafer fab like Infineon or whatever, okay? And they will buy this wafers, they will cut them, and they will put the packaging on them. Usually it's plastic resin, and then they will put legs on them so that it can communicate with the outside world. Now, what product they specialize in is usually around what we call radio frequency. So things like your phone, things like communication chips, this is where Inari's niche really is. And their biggest customer is this company called Avago. Then have you heard of this company called Avago? No. Okay.
No, what do they do?
Yeah, so they engineer radio frequency chips. You think of radio frequency chips as something that is used to communicate with each other. That's why radio. And because electronics is so wide and varied, Inari's specialty is radio frequency, optoelectronics, okay? And optoelectronics, you think of things like your LED, your car headlights, your LED on your phone, okay? So those are the areas where Inari likes to play. The struggle, like what you just mentioned, their earnings have actually taken a beating and dampened by weak Chinese demands for products, is because a big chunk of their chips actually go into smartphones and mobile devices. Now, because of COVID, what happened was all this demand has been brought forward to 2020, 2021. Everyone has bought their device. You don't buy a device every year, right, Louis? I don't know. I don't know. I don't.
No, I don't. Like maybe every 2-3 years.
Okay, every 2-3 years, right? So the demand has been brought forward because of COVID, and now you're seeing a slowdown is because the mobile phones that were supposed to be bought like this year or the year after has already been bought during COVID. Am I making sense to you? Yeah, and all that because of the acceleration and demand. That's why you're seeing plateauing or slowing down. Whereas the guys who are into automotive space, automotive electronics, people are buying new, because during COVID, people don't buy cars. But now after post-COVID, people buy more cars, people are expanding cloud services, all that kind of thing. That's where that niche of semiconductor is still growing. but in terms of consumer space, that's why it's stagnating. Am I making sense to you, Louis?
Yeah, yeah. I mean, that's a very interesting insight. Before I looked into Inari, I didn't know that smartphone demands were actually not growing. Because
Yeah,
it's something that over many years it was growing quite rapidly, right? Even like one person owning two phones, three phones, that's kind of common. Even I have two phones.
yeah.
Yeah, so I thought, oh, maybe it's not some in area that I thought would be declining, given also that some companies keep releasing new models, right? So you think, oh, maybe it will keep increasing, but actually it's dropping.
Yeah, it's stagnating and dropping because the acceleration has brought the demand forward, and because of that, then everyone was rushing to supply it, and then now you have a glut because everyone ramped up during COVID, right?
Mm.
And now you have this ramp up, but yet there's not much demand, and China's economy is in quite a bad shape right now.
Yeah,
Yeah.
so John, I just like a question popped in my mind. It's like, okay, is it because of like that ramp up that's causing them to have too much now?
There's a multitudes of reasons. One is the ramp up, and two is really the demand has really stagnated. Now you think
Mm,
about it, I bought a lot of devices during COVID, the
mm.
2 years. I started my previous startup. It was so hard for us to even get a graphics card.
Wow.
We paid premium because I don't know if you remember the explosion of the crypto mining.
Yeah, yeah.
Everyone was, yeah. So we paid 3 times more from a normal price just to get a graphics card. It's quite
Wow.
crazy, yeah. So using that analogy and comparing that to Inari right now, PC, everyone bought their PCs during COVID. Everyone bought their smartphones, smart devices during COVID, and that demand has actually abated and stagnated. And at the same time, during COVID, a lot of them ramped up because their customers will be chasing. Inari has their end customers, right? They'll be chasing. And when you ramp up, you spend that kind of capex, right? That kind of money to actually grow your plant, and you're in the manufacturing business. It actually takes quite a toll on you. So maybe at this point of time, with relation to that question, maybe we straight away we go to the finances, right? And have a look what we mean by that demand that supply being ramped up. Okay, so let's look at Inari. So now, Louis, if you run a manufacturing business, how do you grow sales? Actually, how do you grow sales?
More sales.
How would you make more money?
Mm, one way would be reduce costs.
Reduce cost.
One
Okay.
way. The other way would be distribute more, like find more distribution.
Mindful. Okay. But more importantly, before you can find more distribution or reduce costs, for you to grow, what do you need to do as a manufacturer?
Or create different products.
Increase capacity, actually,
Oh, okay.
right? You
Yeah,
need to
yeah,
increase
yeah.
your
True,
capacity,
true,
ma.
true.
So it's
So
like if
before that,
yeah, before all that,
yeah, true.
before like let's say you have a restaurant, your recipe
Right.
is very good, but you only have 5 tables,
That's
so you
right.
can only serve 5 customers. So you need 10 tables to like make the money, right? So as a manufacturer, you have to go back to first principles. For you to make more money, you have to grow your capacity, and to grow your capacity means spending money. Okay. So instead of just looking at the normal income statement, I straight away I go to this thing called cash flow, and I look at this thing called capital expenditure. So because your question was, did people ramp up? Yeah, they
Yeah.
really ramped up during COVID. I mean, you look at it, 2019.
Overly ramped up, then now it's like
Yeah,
excess, right?
correct. So 2019, this was way before COVID because this was spent the year before, ma. So they were ramping up maybe because of demand from the customers. But because they ramped up so much, you see, 2020 they couldn't because maybe COVID restrictions, movement restrictions, and all that, and they're still ramping up. Okay. As a manufacturer, you cannot escape this. For you to make money, you have to make more machines. You have to buy more machines to manufacture the products and goods that you are promised to your customers. And there's another struggle in the industry they're in. Their machine goes obsolete between 3 to 5 years.
Wow.
So
That's
let's say
like
you buy a biscuit making machine, the thing probably can last you 10 years, 20
mm,
years, 15 years, 20 years, right? for electronics, because it changes so fast, right? I've listened to people or listed company CEOs tell me the moment the machine arrives, it becomes obsolete really.
Oh.
So I want you to think about in relation to question one, what business are they in? How do they make money? And then secondly, are they profitable and financially stable, right? Before you even look at the numbers, you have to think in terms of the logic of the business. Does it make, how does it work? It's like nasi lemak. Okay, if you go back to nasi lemak, if you are not having enough kacang, enough eggs, kacang is peanuts, ground peanuts, you don't have enough eggs, you don't have enough sambal, you don't have enough timun, you're already stuck. No matter how good your marketing is, you're already stuck. You need more money to inventory. And then if you want to go into like big nasi lemak business, you want to supply Asia. Let's say your nasi lemak is so famous. Tony Fernandez said, please cater for Asia. Okay. Now what do you need to do? You cannot be doing like your normal home cook style already. You have to buy industrial grade kitchen. You have to buy you have to invest in processes to like QA QC or your sambal freeze or that kind of thing to be more efficient because time right. So then in a manufacturing business, you cannot escape spending money to actually grow your scale. Okay, here's the second problem. In the industry where you're in, when you are expanding, does it get obsolete? So nasi lemak, no problem. You buy industrial kitchen, probably lasts you 5 years, 10 years, 20 years, no problem. But in a semicon
to the business.
Yeah. Exactly. But in semicon, you just imagine your phone, how often the technology change, 4G, 5G, you know how rapid it is, right?
Mm-hmm.
You buy a tester for 4G and 3G, once you come out with a 5G phone, the equipment it has to change really. You see? So again, that profitability and financially stable, what they do, they can, but they continuously need to spend money. So you go back to first principles again, you see. Am I making sense? Rather than just looking straight at the numbers, profit growing, that kind of.
Yeah. I think just the cycle of it is a little bit rapid, and like to consider in between of that, there's also like all the logistics, that take up about 30% of the time. So it's like if we're looking at a framework of like a cycle of 3 years, in fact, you only have 2 years.
Yeah.
To manage that change.
Precisely. So I want the audience to start thinking like, don't worry if you don't know accounts or like, does this account make sense or whatever. But you go back to first principles. First principles means as a business, what is the structure of where my cost goes? How fast does it have turn around? How fast do my things go obsolete? You see, and when you think of that, then the numbers become clearer and clearer to you. The numbers actually make sense. You know what to look for. Okay, go back to the nasi lemak again. You want to do Asia's business, right? How often do they pay you?
6-12 months, I guess.
Correct. You see, maybe you're lucky, maybe 1 month, 2 months.
Oh, never,
right?
Never.
But if you're doing on the street, you're doing on a restaurant, it's a cash business, You get a turnaround, a cash conversion cycle so much faster than that of Asia. So then what happens? At the back of it, you need working capital. That means, do you have working capital to last a 3-month, 6 months kind of payment terms for Asia? You see, again, then you look at the numbers, whether it makes sense or not. Yeah, you may have like a $10 billion nasi lemak business, but then every 5 months or 6 months only you get paid, right? Wow, you think about it, the amount of money you have to put on standby just to run the business, the working capital to run the business. Yeah. So I don't know. I mean, you're an entrepreneur, Louis. I mean, we are both in the service business. Thank God we don't have to worry about all this. But as a manufacturer, these are the kind of things you need to think about, Am I making sense?
Yeah. Actually, in agencies, you do have to worry about that.
Because of the...
Yes, the 6 months, 12 months. So normally for smaller agencies, if they attempt to take contracts like that, usually they'll close shop within 1 year. Because you start out with a service business, and imagine if you had to hire a team of 5. And the worst thing about it is sometimes these companies like never pay them.
Oh,
that's when they close shop. Yeah, and with a loss. So when you talk about this, it reminds me of that scenario. It scares me. I tend not to take contracts like that lah, at
Yeah,
this size. Yeah. So
great.
maybe they can stomach it
They
because
can sum up. Yeah.
yeah.
Yeah, I don't think Inari will even allow six. They I'm very sure they have milestone payments. That you know, because capex is so high. You know,
Yeah.
capital expenditure is so high. So more detail about the profitability. Let's see where are they. Okay, revenue is growing, net income okay growing. COVID years, I think they were, because it's a manufacturing business, they were probably stagnated because of all the restrictions. Okay, what else? You talk about operating cash flow. Okay, growing quite healthily. In my look at that, they're growing quite healthily. Okay, so in terms of profitability, financially stable, fantastic. If I'm not mistaken, they're a net cash company. Let me see. Yep, they're a net cash company, meaning the cash they have on the balance sheet is actually more than the liabilities that they owe to people, the suppliers, the banks. So net debt is actually very simple. It just takes the total debt minus total cash and short-term investments. It means whatever debt, liabilities, and everything that you have, minus off the cash you have in hand and the short term. If it's more, then it becomes negative. So net debt negative is net cash.
Okay.
Am I making sense? Sorry,
Yep.
I don't know if I'm going too fast.
Yeah.
Okay.
Thanks.
So in terms of whether I think the beauty about having a net cash business is that sometimes you may be push businesses that the margins don't make sense. But
Correct.
if you're in a position of a net cash, you will say that, hey, sorry, I may not want to take on this business because it doesn't make sense marginally to me. For every dollar that I'm taking, I'm actually like incurring higher costs. So but if I'm net cash, I'm healthy. I said, okay, may not be the best. Okay. So I can like push it away. Okay. Now here comes the interesting part. Who is the audience and how big can they grow? Now we all know that the phone, the personal device company, the personal devices space is actually a very, very good space, very big space. Their market is not just confined to Malaysia. That's the beauty of it. I mean, virtually it's a global demand for their products and services. Okay, how big can they grow? Obviously, you can Google it. Just type like RF chip demand globally, and you will get some. Now, don't worry about the accuracy because whatever they say, and you have to pay few hundred thousand, a few thousands of dollars to like get a report. Even they have to make an estimate. It's not a precise science figure, but you just need to know whether it's growing or not. That's it. Okay. So let's see. This one is Global Newswire, 7.1% CAGR. So this is how I look for addressable market. So I know once I understand which business they're in, I try to size up the addressable market by looking for numbers like this. And I don't just look for one, but I look for a few. So I know it's like, is it validated or not? Things like that. Okay. Right. Am I making sense, Louis, at this point?
This CAGR, I don't understand how does it relate to the
Okay.
addressable market.
Very good. So if we are looking at the RF chip, like this is actually the global semiconductor chip size. Okay. So it includes like your logic chips, it includes like even your controllers, all this kind of thing, RAM, memory, all that kind of thing. So we want to know as a industry as a whole, in which Inari is a subset of it, how fast is this market growing? How fast is this market growing? Because once you have an indication of how big or how fast this market is growing, it can actually help you like make an assumption of how big the sales can grow.
Okay.
Am I making sense? It's like advertising industry. If it's like no one's spending on advertising and the trend is coming down to a trend, let's say like TV, traditional media, right? Billboard. If you get industry reports that tell you that billboard spending has been coming down year on year, and then all of a sudden you find a company like let's say there's one that just recently listed in Malaysia called Senijaya. Okay. So billboard spending, let's say if it's coming down, I don't know, I haven't studied, I'm just making an assumption. If it's coming down, right? And then here you are, you're invested in a company like Senijaya, where the market is actually slowing down or reducing or shrinking, right? Then for you to make a projection how they grow their sales, you have to dig a little bit deeper, But my first thing that tells me is that you're already in a shrinking market. Unless you're doing something different that you can take away either market competitor, share, or whatever, then only then I know you can grow your sales. Ma. If not, the logical reasoning will be I'll be shrinking my sales.
Is there like a minimum that we should look for? Like if we look at the CAGR or any positive is good, like example 2%.
Oh no. Very good question. You may be having a very high CAGR, but in a very small and niche because the base is very small. So there's no right or wrong answer. It can be a 2% CAGR, but the industry is so big, like 400, 500 billion. 2% of 500 billion versus 20% of 100 million is a huge difference,
Makes sense. That's actually very, very good insight. So both sides, right?
Yes. There's no such thing as big or sorry, go ahead.
20% on a huge market size, and it's a winner for sure.
You see where I'm coming from?
Yep, got it.
So like Nvidia, instead of looking at just the global semiconductor chip market, Nvidia or Arista networks, right? You have to look specifically at the niche. Like Arista, we covered this in an earlier episode. If you haven't watched it, link in the comment section below. They are very niche into communication devices. Not your normal phone communication. Communication modules for network communication and AI communication, which is very, very niche. But that is a space that did not exist 20 years ago. So their addressable market size may be, I don't know, maybe $1 billion, $2 billion kind of thing. But they're growing at 20% because it's a market where it was never discovered before. Versus that, now you're talking about the global semiconductor chip size. The last I got from Semi was about 500 billion, 600 billion. So when you're growing at 10% of 500 billion, is big, It's big. Single digit, high single digit is already considered very big because the base is so big.
Okay.
Right. Versus that, let's say you are in a 1 billion market, but you're growing at 20% a year. It's different again. So no right or wrong. But very, very good question.
Got it.
Louis. Yeah. I hope you see the correlation in between.
Yeah.
How I see.
Because in the equation there are two, right? So
yes.
One figure. Because I was thinking like CAGR, like we just did the ETF compound. I was like, didn't think about the market size.
Correct.
Because like it's so interesting because it's the first time I've seen you use CAGR in like calculating the market size. Maybe you always do it, but this is the first time we do it on the show.
Yeah, do it live. Yeah, it's a habit of mine already. So some things I take for granted, I straight away like.
Yeah. Correct.
Yeah. Okay, so moving on to the next question, and the last one is: are they cheap or expensive? So again, without building my own model whatsoever, I mean the beauty of what I like about Ticker is like it's a tool that is so usable for a lot of and even for the more complicated investor or even more for the simple-minded investor, they have a tool for everyone. So one of the things that give me a quick indication of their valuation is actually I just go to this thing called valuation, okay? And I try to look for this thing called the last 12 months price to EPS. EPS just stands for earnings per share. Okay? So I'm virtually trying to find like a ratio, their PE ratio, price to earnings. Now, for those of you who are unfamiliar with PE, just a quick refresher, price divided by earnings is just to show you a multiple of roughly how much or how fast are you going to get your money back. Now, let's just say a business makes $2 on their total profit, okay? And if you've invested $10 into this business, which makes $2, it takes you 5 years to get your money back. Making sense? $2 of profit, I pay $10 for the business. In 5 years, I will recoup my $10 investment. Okay. Obviously, the lower the PE, the better in general, and the higher the PE, we try to shun away. Because if, let's just say you're looking at Nvidia, which is like a PE of about 200 times, that means you pay $10 for the business, you need 200 years for you to recover the money. That's how obviously
maybe for our descendants.
Yeah, maybe for third generation, not even second generation, okay, third generation. Yeah. So again, I'm oversimplifying it, but that's the nuance of how we look at it, roughly. Okay. So like for Inari, I try to gauge what is their mean? Where are they like roughly valued at? What's the multiple, right? So the mean is actually anywhere between 22 times, and the high and the low is anywhere between 64 to 3.4 times. Okay. And after that, what I try to do is this. I look at where have they been in terms of peak and at the bottom. So I want to see, are they like very cheaply valued now or very expensively valued, compared to the peak, right? As I was saying, I try to look at the mean of where they are in terms of the high and the low, and I try to find a good in between, so that when I'm buying this at today's prices, does it make sense? What kind of margin of safety do I have, right? Yeah, I think the beauty about Ticker is that it has all this data available at the click of a button. Obviously, this is not like because you see it's at the bottom and then straight away you go and buy, right? No, you have to understand like where they are, why is it there? Have they actually grown their business? It's not just one number and then you just act on it, lah. So again, the 4 questions, okay? Are they at too high or too low of a mean? Where they are today, they are like 32 times, okay, 32 times, which is, I would say, somewhere in between. I mean, at the peak, they were like high of 64, which is here. This was during the COVID crazy days, but they were also at the low of I think the lowest they've gone to is 3.4 lah. So I don't know where is 3.4. Somewhere here. When they first started listed. Okay. Yeah. So it's not fair to expect valuations like 3 times today. Because can you imagine, right? In 2011, 2012, they were probably a very small setup, much smaller than where they are today. They're doing, how many billion in sales? Let me see. They're doing 1.5, kind of 1.6 billion kind of in sales. 2013, they were probably doing, let me see, let's drag all the way back. Can you imagine, in 2012, 2013,
It was a little sprout.
yeah, you just imagine it was so small, right? They've virtually 10x where they are today from
Wow.
10 years ago. So kudos to them, you see. And you shouldn't be expecting 3 times valuation, PE of 3 times valuation versus where they are today. If they've already proven that they can scale and this kind of size, you see. So yeah, I hope it makes sense to you, Louis. So the four questions: business in the what business do they do, and how do they make money? Are they profitable and financially stable? Who's their audience? I've shown you how to look at CAGR. And last but not least, are they cheap or expensive? Yeah.
Yeah, so I mean, when I was doing the research around this, I couldn't really find as much details about the business as compared to like the companies that we covered before, the more global companies. So when we study local companies, right, with less information, less news, what would you say would be a better indicator?
Very good question. Now, if you look at the website, I think they don't do justice to the business. And I'm saying that as a compliment.
Yeah.
You may have a great business.
Mm.
And one thing I find as a struggle for most Malaysian companies is they don't emphasize the role of IR very well.
Mm.
IR stands for investor relations. And usually they think of it as a subset that the chief financial officer should do. The struggle is this: the chief financial officer is already so busy doing so many other things, especially looking at strategic financial decision, on that kind of thing, that more importantly, the IR job is actually, for me, a full-time job. Your role is to actually tell the story of your business. Drop out good stories, whatsoever. And I think that's where Malaysian listed companies don't understand the value of it. I mean, you look at American companies, right? They do it so well. Like what you said, when you cover like the Nvidias of this world or the Alibaba, whatever, you can find like investor decks. You can even find like simplified layman explanation of the business they do. And here you look at it, what does it mean? 1.8 million production floor space. Okay, floor space, yeah, but what do they do, right? Design development, new product qualification. So again, who is this intended to? It's not intended for the normal investor, retail investor. This is intended for their suppliers, their customers, people who are already in this space.
Yeah, in the know, they understand
Yes.
jargons. I feel like it's a lot of jargon that if I was like interested, I would feel very intimidated. Like, do I need to first understand the industry in and out?
Correct.
Or else I'll get scared, what am I investing in?
Yeah, you look at this package assembly. What do you mean? What is a package? Remember I told you the biscuit and then they wrap. So yeah, package level testing. Okay, like if you only unless you understand the industry well enough, then then it makes sense of all this jargon. But if not, it's like straight away like, and that's why people turn off. That's why people switch off.
Yeah.
You see.
Yeah.
So like I was looking at the IR website yesterday to prepare for this that one. I'm like, oh my god, it's so far removed from from Actually, one thing I really like about filings of US companies, their S1 filings or their annual report filings, right? Their 10K. There's a section, usually it's just like 4 or 5 paragraphs, and it describes the business in such concise and succinct manner that even a layman investor, even they try to avoid as much jargon as possible, but within 5 minutes, you roughly get to understand their business. I was going through the AI yesterday. I tell you, it's like so far, like what I told you about optoelectronics, about RF, right? That's from my domain knowledge of like 7 years, 8 years understanding the semicon business.
I would imagine.
Yeah.
So like I'm just wondering, like for someone who's just like, maybe heard of like the price surge, okay, like in May, June, the prices went up quite a bit, like 15-20%.
Yeah.
Based off this news, maybe someone might be thinking, maybe I should invest in it. But then when you look at it, right, the first question I don't know how to answer.
Yeah.
Should I still invest in it if I cannot answer the first question?
Correct. This is the price surge you were talking about, right? From
May
215 to like
yeah. So like that alone would be interesting for the lay person. But then when you dig in, if we just want to answer the 4 questions, the first question I think most people struggle
already. Yeah, sure struggle already.
Yeah. Then how, John? Would you say like if let's say someone doesn't really get it, should they still invest?
I don't think you should. I'll be very honest. I don't think you should, because then what you're doing is you're virtually speculating.
Because like if you base off the rest, right, those are figures, right?
Yeah.
Now you start to look at the financials and etc. You cannot answer the first question, but you're looking at numbers now.
Yeah.
Only purely numbers.
So if you're looking at just numbers, but how are these numbers going to sustain itself? Where's the tailwind of the growth? It's a question mark.
That's the thing. Yeah. I was just thinking that because I was looking around for this information around Inari, I couldn't find it.
Yeah.
There's a lot of news though. There's a lot of like forum threads, and I don't think they're reliable as much as as detailed as they want to go. Like it's circulating the same thing but giving their own opinions around it.
That's right.
I think there's a lot of caution around these things.
Right.
If you don't get the industry, maybe try to understand it first, right?
Yeah, exactly.
Try to dig a bit deeper, understand what they're doing, understand what you're buying. Right. Okay. So yeah, that's very interesting. I think John has always told me he's very big on semicon. It's very big I am not. I don't know anything about semicon, so that was a very interesting deep dive.
Yeah.
Especially in terms of like the manufacturing cycles. That was very interesting.
Yeah.
So not very profitable if you think about like all the machines that got obsolete, right?
Yes.
Okay, so now to wrap things up, we're going to go to our last section, which is the investing book recommendation. So what's the investing book that you recommend beginners today, John?
Okay, now today is going to be something out of the norm. Okay, I'm actually going to actually introduce a book about history.
Woo! Okay.
And here, this is why it's something I said.
I never fails to surprise me. Honestly.
Yeah, so I'm trying to bring up the book here, Incredibly Wealthy. Okay, and this is something that popped up on my Amazon feed that I thought it would be interesting. So I straight away I went to buy a copy off Amazon. Okay, so I'm going to share my screen now. So the title of the book is called Great Lives from History: The Incredibly Wealthy. So instead of looking at modern day kind of financial barons, this book actually goes back all the way until the middle century, 1500s or whatever. So they
The
talk about
Rockefeller, sorry, I can see.
yeah, the Rockefeller. So this is Andrew Carnegie. Okay.
Oh, Andrew Carnegie.
Andrew
We've heard.
Carnegie, Warren Buffett, Queen Elizabeth. I don't know who this guy is. I can't remember. This is Oprah Winfrey, obviously. I don't know if you heard of this guy called Mansa Musa, one of the richest men in the
No.
world. Okay. So it's
Wow.
actually covered in this book.
Mhm.
It's actually covered in this book.
Mhm.
It talks about Rockefellers, it talks about Trump. So it all the way from like
Rothschild.
even before Rothschilds. They talk about someone that they didn't even know there was a financier who was born in the 1500s.
What?
Yeah, and they actually talked about how when the King of England actually seized his wealth from his family, it took 20 years to consolidate the business. That's how rich he was.
What?
Yeah, he was actually lending money. So you think about modern day, right? You know, arms dealers, they actually need money to finance war or whatever. We have modern day arms dealers, right? This guy was financing war in the 1500s, you know.
Wow.
So I can't remember his name. I was just glancing through the book. The beauty about this book is it's I think almost 2,000 pages. But yeah, because it's
Right,
categorized
it's biological, right? Yeah.
alphabetically. Okay. So what you do is you don't need to read the book end to end.
Mm.
You read the book by selecting a chapter. You flip or maybe C. C. You go to C, and then you find all the guys in C lah. You go to A or you go to O, then you find Oprah Winfrey there lah. So it's usually one person,
J?
1.5, one page.
John
Huh?
John Ho. I go to J.
I wish. Yeah. I think to qualify you must be at least a few hundred million and above, right?
Okay. Next edition, we'll see.
Next edition, hopefully, right? So yeah, I found it very fascinating because you want to see through time how people actually make money. So there's this episode on YouTube. I can't believe it's free. Okay, it's actually the man who built America. So they will look at people like J.P. Morgan. They will look at Andrew Carnegie. They will look at the robber, they call it the robber barons of the 18th century. They look at the train barons. They look at the banking barons and all that kind of thing. So too bad. I don't think enough is written about Asian wealth. Asian really rich people. There are books, but it's very, very low key, low profile, not marketed well enough. But I think the context of the book, why I feel will be good for audiences is this. You get to see how capitalism has changed over time. So like in the 15th century, financing until today is still the same. Concept is still the same. How you make money, you get people to finance you and then you go and finance people. Okay. Today, you think about it, banking system is no different. So that has we've stood the test of time. Okay. Then you talk about the railway barons of the US. All right. Today, once you already put the railways in, whatever, first mover advantage wins. You cannot go in and upend these guys because infrastructure is already built. Yeah, you can go upgrade or that kind of thing. So that's one angle. Okay. So those kind of businesses, if you are in early, you've put in the money and time, there you go. It's an entrenched business already. And then when you come to see someone like Bill Gates was also featured in here, right? This is an industry where he created out of scratch. I mean, office productivity, whatever. So then you come to see the Facebooks, the Metas, right? You see the transition of wealth that has happened and the industry landscape that has changed, right? A lot of the guys who made money in the early 1800s and all were all oil guys, 1900s, all oil guys, right? And today you see is like the tech baron. So I just wanted the audience to actually look at the contrast in that, the contrast in change of capitalism, and how like somewhat seemingly ordinary industries or ordinary people can actually become very, very rich. You know, rather than just reading about Buffett, Munger, or that kind of thing, boring ma. You read like contrast, you know, like Mansa Musa, the guy over here, how he made his money. You know, he talked about the Ottoman empires. They even talked about people from the Ottoman empires.
Yeah.
Yes, you see, so it's for me. I felt that was interesting. Like I can't read the book like page to page, right? But One
2,000
day maybe.
characters inside. I mean, you probably need like a few years to finish.
Yeah. But the beauty about the book is like it's 3 volumes, by the way.
Oh, okay.
So there's volume 1, volume 2, volume 3. If you can see this picture over here that I'm highlighting. So
Yeah,
there's 3 volumes. Okay. You can buy the bind version for about $16, which I think is pretty reasonable. Yeah, pretty reasonable. It's out of print already. And yeah, I think hopefully it can give them inspiration on like how wealth is created. How do these people think? They even talk about King Midas. You know King Midas?
Yeah,
You know the guy who touched and then gold? Yeah, so there's actually 2 pages about King Midas.
that's interesting.
Yeah,
But I mean, we often see like, okay, like a lot of people think there's only a few ways to make money,
correct.
become very wealthy, but in fact there are like 1,001 ways.
Thousands of ways to make money. Yes. So this,
Ways.
yeah, hopefully you like this. It's like completely from left field, but
But it's interesting because I think that sometimes you do need that kind of pollination,
yes,
cross-pollination, just to make yourself more creative, think out of the box, right? Rather than just, okay, it's just investing. But we also have to understand that there are other ways to make money, and this can also help you with your investing knowledge as well. As you
precisely.
understand different businesses. As you've seen the semicon, if you
Yeah.
don't get it, can you invest in it, right? There's a lot of information we need to learn. Okay, I think we can wrap up today's episode. So thanks, John, for sharing your insights about Inari. For those who enjoy semicon like John, do share with us if you have invested in Inari. For the rest, what do you think about this episode? Share your comments below. So thank you guys for tuning in. If you like this episode, make sure to give us a thumbs up. And if you want more content from WangHiro, make sure to subscribe to our channel. So we'll see you guys in our next episode. Bye-bye.